This is the study session on financial reporting and analysis and the reading on understanding balance sheets. Let's go ahead and get right to the LOSs. Describe the elements of the balance sheet: assets, liabilities, and equity. Remember what I said back in those first two videos in this study session, that the balance sheet is like taking a picture of a company on any given date, while the income statement is like watching a movie. And so the balance sheet is a snapshot of the company's resources, or its assets and its sources of capital. And so I always like to think of it as what's on the left-hand side of the balance sheet is all of the stuff that the business owns, and on the right-hand side of the balance sheet is all of the stuff that the business owes. Right-hand side is the sources of capital. So assets are resources which a company owns or controls. Things like cash, of course, that's a short-term asset. Things like property, plant, and equipment. Remember back in the capital budgeting reading, we talked about looking at those property, plant, and equipments not as just dull and boring assets, but in the exciting product lines that they generate. Liabilities are the accounts that the company owes and is expected to result in a cash outflow. And then the equity is the owner's interest in the company's assets. And remember that as a shareholder, you have a right, you have a claim on the income stream generated by those assets. Not the assets themselves, but the income stream generated by those assets. There's the fundamental accounting equation: assets equals liability plus equity. Assets are broken up into two parts: current assets and long-term assets. So property, plant, and equipment, and investments and other assets, those are probably long-term. Liabilities, the same thing: current liabilities, long-term debt. Those are bank loans and bond issues, and then any other liabilities. And then equity is common stock. Of course, accountants record common stock in terms of its par value, which is usually pretty low. Oftentimes it's even zero. And then additional paid-in capital, and then retained earnings. Remember, retained earnings is all the stuff, all the income that we have generated over on the income statement over time. What's the goal of the business? Maximize shareholder wealth. You hear me say that in many of these videos. And how do we do that? A bunch of different ways, but the result is a swelling of the equity portion of the balance sheet because we're generating lots and lots of income. Here's a nice picture of Nike's consolidated balance sheets over the last couple of years. Notice that there are current assets and then there are long-term assets. So those total assets are $23,259. Those are in the millions, so that's up to 23 billion. And then liabilities, there's some long-term debt. Notice there's no preferred stock at Nike. And there's a total shareholders' equity. And then the fundamental accounting equation: assets must equal liabilities plus equity. So the 23 in the middle of the page has to equal the 23 at the bottom of the page. How about uses and limitations of the financial information and analysis contained in the balance sheet? Well, as financial analysts, we're using all of these financial reports to try to make a judgment to determine perhaps the intrinsic value of a business, to try to make a determination of whether the firm and its securities are under or overvalued. So we're going to analyze the firm's ability to meet its short-term obligations. We call that liquidity. To meet its future long-term obligations. If that's not possible, then there's the threat of bankruptcy. And then make distributions to shareholders. Remember that those dividends are paid out of retained earnings. Limitations are that although the balance sheets are always historical, it's a picture of a company's business on any given day, and then that looks at what's happened in the past. Some of those accounts are measured at historical cost, but others are measured at market value. And of course, the balance sheet, like other financial statements, leaves out other important aspects such as the culture of the business, the attitude of the business, management skills, the board of director. Now, the International Financial Reporting Standards tells us that in Europe, this is called the Statement of Financial Position, while in the U.S. it's called the balance sheet. I always learned it as the balance sheet. That's what I always called it, but you guys need to make sure you can distinguish between the two. Both of them require to distinguish between current and non-current assets and liabilities. And here's a good, just a generic example, Prudential Limited. Current assets, non-current assets, total assets, and then equities and liabilities. Lots of financial institutions like to present their balance sheet that's liquidity-based in order of liquidity. It's not required to have separate classifications as long as the liquidity-based presentation is, of course, reliable and more relevant information than the classified balance sheet. And here's a look at Barclays. Notice Barclays starts with cash. Of course, cash is the most liquid, works its way all the way down to things like deferred tax assets and property, plant, and equipment and retirement benefit assets. So those are in decreasing order of liquidity. All right, current assets are the assets expected to be sold or realized in cash within 1 year. Current assets, and of course, the classic example are things like accounts receivable and inventory. Non-current assets are long-term assets. Those are things like, for those of you who just watched the income statement video, the bulldozer that a construction company buys to build an airport. Current liabilities are expected to be settled within 1 year. Non-current liabilities are all those liabilities that are not classified as being current. And then a measure of working capital is the difference between current assets and current liabilities. And this is an extremely important part of the goal of the business, which is, of course, to maximize shareholder wealth. But one of the ways we do this is to maximize working capital management skills so that we don't pay too much interest on our short-term liabilities and that we can gain as much interest as possible on our short-term assets. And here are some examples. I've talked about these before. Current assets, cash, cash equivalents. There's receivables and inventory, property, plant, and equipment, investment properties, goodwill, which occurs after mergers or acquisitions, intangibles, and then accounts payable and trade payable, accrued expenses. Non-current liabilities are deferred tax and long-term debt. Don't forget to include bank loans in there as long as they mature for in excess of 1 year. All right, non-current assets, cash and cash equivalents are highly liquid short-term investments so close to maturity that the risk of significant change in value is minimal. Demand deposit with banks, amortized cost and fair value are unlikely to be materially different. Marketable securities are things like stocks and bonds that other businesses own. Trade and accounts receivables are accounts that we've provided to our customers in which we've delivered a good or a service and they've promised to pay us. Inventories, physical products, raw materials, and work in process. Big difference. The international standard calls for these inventories to be measured at the lower of the cost and the net realizable value, which is the difference between the selling price of the inventory and the cost of the inventory. While under the U.S. rules, they are measured at the lower of cost. So that's the same thing as the international standard, but market value. And other current assets. Non-current assets, property, plant, and equipment. Think of those as the long-term assets. Don't think of them as dull long-term assets. Think of them as, boy, those product lines that are generated by those assets, like a Harley-Davidson motorcycle or a smartphone. But of course, it includes things like land and buildings, machinery and equipment that's expected to provide a benefit for more than a year. In fact, many of these tangible assets, the property, plant, and equipment, last for really, really long times. Investment property, these could be apartment buildings or malls or parking garages, used solely to earn rental income. Intangible assets include things like trademarks or licenses or patents. Goodwill, said this just a few minutes ago, this arises after some kind of a merger or an acquisition. It's the excess value created when the purchase price of a company exceeds the acquirer's interest in the fair value. What about the different types of assets and the measurement basis of each? All right, so financial assets are financial instruments defined as a contract which gives rise to a financial asset of one entity and a financial liability or equity. So there's the general definition for a bond or a stock. They can be measured at fair value or amortized cost, and the changes in value can go through profit and loss or OCI. Current liabilities, these are trade and accounts payables, which an entity owns its suppliers, usually with maturities that are really short term, probably not more than a year, probably not more than 6 months, maybe even that's an excess time period. Notes payable, these are financial obligations in the short term, accrued expenses that have been recognized on the profit and loss statement, but for some reason or another we haven't paid them, and deferred income. Non-current liabilities, these are loans or notes, bonds payable, usually reported at the amortized cost. Remember back in your original undergraduate accounting days, you had to amortize the bond premium and the bond discount. Deferred tax liabilities, this is because we put together two sets of financial statements, one for financial statement purposes and one for tax purposes. And there's probably a temporary difference that arises between those two, mostly because of the non-cash expenses. Sooner or later, those temporary timing differences are going to resolve themselves, but sometimes they don't. That's a discussion for an intermediate accounting class. How about equity? Components of the equity portion of the balance sheet. Of course, there are in general two sources of capital there. Businesses can issue preferred stock or common stock. Businesses can also repurchase their outstanding stock, and then that goes back into what's called treasury stock. And then interest in other companies, accumulated other comprehensive income, and then retained earnings, which are the earnings that is retained and not paid out as a dividend. Here's Procter & Gamble's 2017 annual report. Notice that Procter & Gamble does have some preferred stock outstanding, but look at the paid-in capital, 63 versus the common and preferred of 1 and 4, and so that's just the par value. And a lot of companies have $0 par value. There's the stock option reserve. There's the other comprehensive. There's a loss for Procter & Gamble. And there's treasury stock. So that's 93. Boy, that's huge. So it has repurchased 93, almost the same amount that it has retained. And so note that preferred stock accounts for 1 out of the 55 of total stockholders' equity. How about a common size balance sheet? Of course, this is the exact same thing that we did back under the income statement. We use the common size balance sheet to make a comparison against other companies. It's not an accounting requirement. And lots of times, as with the income statement, there can be some cross-sectional analysis trying to figure out which firms are under or overvalued. We can do this vertically or horizontally. And here's a good example. I did one calculation for you there on the side. And so this is the 2016 calculation. If you take inventory of 950 over the total assets of 3250, you get that almost 30%. So you can get a sense of which of the assets and which of the liabilities contribute most to the total. And what this does is allows for this common size comparison. If you're taking a look at someone like Nike, which we've had in a couple of slides and in a couple of the different slide decks, and with someone like Under Armour. I mean, if you want to compare sneaker companies or athletic apparel companies, then the common size balance sheet and income statement helps in that regard. How about if we calculate some liquidity and solvency ratios? Liquidity ratios, current ratio, quick ratio, and cash ratio. Since the LOS does say to calculate, you'll have to memorize those formulas, interpret them. And so here's how you should think about liquidity ratios. Liquidity ratios that are too high, they mean something that the firm is underinvested. You know, you wouldn't want a current ratio, which is current assets over current liabilities. You wouldn't want one of, let's say, 5. Well, that means that the firm has invested way too heavily in current assets, which have a very low, and sometimes even negative return. So liquidity ratios that are too high tend to indicate underinvestment, but liquidity ratios that are too low, let's say 1 or less than 1, that's going to indicate some problem with being able to meet the short-term obligations. Solvency ratios, which measure financial risk, include things like, notice some of those formulas, total debt, long-term total debt, total assets, or total equity. So the measures here are comparing long-term sources of capital versus total assets. And so the risk that these solvency ratios are too high is, of course, bankruptcy. If look at the debt to equity ratio there in the top middle. If the debt is, let's say, 10 and the equity is 1, well, what does that mean? That means the firm has tons of these explicit promises that it's made to the bankers or the bondholders, which then puts tremendous pressure over on the income statement to generate enough operating income to meet those debt service requirements. So high solvency ratios indicate an increase in the threat of bankruptcy. But then on the other hand, low solvency ratios, which would be, let's say somewhere around 0 if the firm is not using any debt at all, that means it might not be taking advantage of leverage opportunities. And clearly it's not taking advantage of the interest subsidy that is provided for those firms who issue bonds and take out bank loans, because interest expense shows up on the income statement and it lowers the tax liability. And so in the interpret those kinds of ratios, I would remember for both liquidity and solvency ratios what the risks are if they're too high and what the risks are if they're too low. Now, trying to define like what is too high and what is too low, I mean, I picked 5 and 1 in my examples, but clearly what you're going to do is perform a trend analysis to see where these ratios have gone over time, and then you're going to compare it against its main competitors. And that helps you determine which levels of ratios are appropriate for which business and which kind of an industry that it operates in. Here's an example back to Prudential again. The question is, has Prudential's liquidity improved from 2016 to 2017? So what we can do is calculate the ratio. Let's pick the current ratio here. And so in 2016, it was 144. In 2017, it was 140. It's probably not material enough of a difference for any financial analyst to care too much about. And so the answer is probably no, since the number mathematically has gone down. And that completes our discussion on the balance sheet. Now we'll do my favorite financial statement, which is cash flow.